Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 25 minutes here on Options Guide TV. The markets are still crazy. That simple. We did get a jump up in the VIX. The VIX is now trading at 45 right now. The volatility index, it tracks the S&P 500 index. On Friday, we put a trade in with the VIX at 39, going out to the April 16th expiration. And I want to talk a little bit about that trade because, as I mentioned on the show, and that I highlighted an article that we have in my x.com that is called Decoding the VIX and talks a little bit about how the VIX index actually tracks the futures market than it does the actual valuation in the index. So on April 19th, I figured I'd come back and take a peek at where our position is at, right? It's a very short-term trade, like the trade, and don't even mind doubling down on the trade if we have this opportunity. Mondays are usually nutty days in the marketplace. For some reason, it just seemed to be on Mondays, but there's a little bit of logic in that. Some news headlines hit the market, gives people time to digest what is going on. So overreactions are usually going to happen on a Monday more than any other day of the week, and that's your argument. Now, there's no actual proof behind that, but if you go back and look at all the big market crashes, a lot of them happened on a Monday. All right, so let's share the Tradier Pro software. And here we see the actual synthetic long combo. Now, I mentioned on the show that this is how we determine where the actual futures market is at. Now, if you have a futures account, you can go in and look at the quote on the option contracts that you are trading. In ours, I'm going to highlight over here that we are trading the 16th expiration, and we are looking at right now the market is right around 32, and I'm going to send this. Let's send this one to the ticket, and let's look at. So this is synthetically long stock. It's telling you that the VIX index is at 43. That is the spot index. That's where the marketplace would have to settle at expiration of our option contracts. We want the actual VIX index, the spot, to be below our short strike, which is the 31 strike call option. So that's what our goal is. Right now it's at 43, but the market actually thinks that this expiration, the VIX is at 32 or somewhere close to that. Well, the market's already moved on me, actually. Let's look at it. Yeah, so you literally go down, and I'm going to clear this out, and you find where the call and the put are almost equal, right? So at the 30 level, this is where we're almost equal, and that'll mean that, the VIX actually has came off a little bit, and the futures have too. So our trade is going to be looking interesting once we pull it up. Now, this all just happened like within 10 minutes. Is the SPX going back up again? SPX is now up again. Wow, interesting. Big volatile news this morning. I don't know why this just happened in the last 10 minutes, but there was a headline, fake news that came out of Washington saying that the tariffs may be suspended, and then they quickly retracted it. Nobody really knows where it came from, at least nothing that I saw on any of the financial networks figured it out. The market spiked, and now it's back down, but now it's back up. So we're seeing the VIX actually come in just since we started the show. Crazy times. And now we're looking at the April 16th expiration, which the box is highlighting, showing over here. And we just go over and we look to see where these markets are fairly the same, right? Right about here. Okay, 530 on the bid there, 570 on the bid here. Yeah, I'm going to use the 31. Okay, so synthetic long means we would buy this and we would sell this. And that's a net debit of 80 cents. And we're paying a little bit more for the call. So we're looking at it at about $30.80 is about 65 now. Well, we'll call it 80. $30.80 is about where the futures contract is for the April 9th expiration. We just made a synthetic long position, easier than going out and trying to get futures quotes. And in my mind, at least it is. And what we put on for a trade, and I'm going to run back to the what if calculator, is we went a short call spread where we sold the 31 strike and bought the 36. So based off of the futures, the market's where we want it to be. It's below 31. Now we put this trade on for $1.05, and I like that number. That was and I got a fill on it in my own account at $1.05. So it was very feasible to do. As a matter of fact, when I took my screenshot, it was showing the midpoint at $1.18, which is probably why I got filled at $1.05 so quickly. But yeah, it was at $1.18 at some point in time. So with that said, let's send this to the what if calculator, or send this to the ticket, to the trading ticket. And now we're at 120. Okay, so the market is up from 29, it's about where the futures were at, to now almost 31, $30.80. And on our position, we've lost 23 cents. No, 15 cents. 125. Yep. We'll call it 15 cents. So we'd be down about 15 cents on this trade if you wanted to get out. I still have confidence that, especially after the Monday gets done, that the markets will settle down a little bit. And you just saw that. Interesting in that. This was a great example, actually. The SPX turned positive. Oh my gosh, now we're negative. The SPX turned positive for a second, and all of a sudden the VIX dropped to below 30. Yeah, and now it's fairly close to 31. So now it's bounced back. So it's all over the place. All we need is the market to settle down a little bit, not necessarily go up. And that's the biggest thing here. The 30 value on the VIX is very hard for the VIX index to control, to keep that level. And I only like to trade in the normal monthly expiration, which are highlighted here inside the Tradier Pro platform. Very nice for you. It doesn't have a W, means it's not a weekly, it's a standard option. Go back to the old day option contracts that expire on the third Wednesday of the month. And then we got the May expiration. So I'm going to look at the May expiration too. Now that the VIX has spiked above 45, I mean, we haven't seen this since COVID levels back in the day. So let's look at a May. So 44 days away. I mean, the VIX would have to be, I mean, I like to look at it, and I haven't looked at where the VIX is at as far as the synthetic long futures position. But where would I put a trade on? If the VIX was trading at 25 in May, would you think that the markets could be below 25 in the VIX at that point in time? With COVID, it took it forever for the market to get below 20. It stayed the VIX market, just in general, 20 was the new 15, if you will. And to break that level was really hard to do. So is this worse than where we were? Do we get some news headlines over the 44 days? And would those news headlines be positive? Do we know them to be positive? Interesting, right? I mean, if it's above 25, I think I do a trade. That's simple. All right, let's look at May. And if you have any questions about the trade that we talked about on Friday, I'm happy to address them. Put them in the chat box. I'll keep my eye over here and take a peek at them if we can. We got the May 21st expiration over here. I'm guessing it's somewhere around 25. No, that's higher. 28. Yeah, well, it's actually 27.50. It looks almost perfect as far. I mean, you can figure it out by looking at either the option contracts. I just try to make it simple. I guess I don't want to go into too much detail. But if you just look at where the call and the put are fairly close, that gives you a good indication. And I'll take it one step further, and I'll put those in the actual calculator here. So we're going out 45 days. This is actually kind of scary for the market in general, that the VIX is still high. So they're seeing a lot of volatility going forward, implying there isn't going to be a ton of news that is positive, I guess, that maybe we don't come to a head as far as the market. Okay, so it's 27.50 is about right. That's using the 28, right, minus 50. So 28 minus 50 would be 27.50. So the 27.50 should be trading for 0. Buy that, sell this. It's showing a midpoint of 5 cents. So I like this. Going out 44 days, and we're looking at, there's got to be something that will settle the marketplace down and bring it below 27.50. Now, the problem about 44 days is that if we put a long spread on, if we buy a put spread, it takes a while for you to get paid on a spread. You need time decay to happen. So that's an issue. And then also to go along with it, if you sell a put spread, that might be the same scenario. So tempting here to even think about, do we buy that put? Do we buy an out of the money put option? Spend $2 on it at the 22.50, but vol is going to come off. Implied, where's the VVIX at? 161 is the volatility of the VIX index. 100 is probably normal. 161 is there, and you're paying a lot of juice. That's a tough one. You can't buy something out of the money. You'd have to buy something up here. You'd have to buy the 35s or something, thinking that the market's going to go down and finish between 25 and 20. That would be your goal. Or you just put it on and you let it ride, and you do the short call spread or the long put spread. So the short call spread, sell the 30 by the 35. Yeah, that's $1. That's not bad. Sell the 30 by the 35. Or do we go this route and we buy the 30 for 750 and sell the 25? 5 points wide. All right. Here's what I'm going to do. I'm going to get a little bit more speculative. I'm really hoping that negotiations will open up and that the markets will be set free. And I can't fathom that in the next 44 days, we don't have that scenario. I don't want to necessarily trade anything this week, maybe next week. If you had some cash on the sidelines and you wanted to try to bottom fish, you can bottom fish with particular stocks or just buy some indexes. That's feasible. If you've already been hit, it's really hard to hedge at this point in time. If you do, you want to buy put spreads. You want to buy something where you are buying the protection and then sell something to protect against it. You could do that in NVIDIA. We talked a lot about the covered call on steroids. The other position to be on stocks that you're nervous about, but you don't know if you want to sell, would be to do a collar where you sell a call, giving up some potential upside, but then buy the put to protect the downside. We'll look at a couple of those positions right now. But this is just a pure speculative trade on the VIX index using that May option contract, thinking the markets can settle down, finish below 2750 by that expiration date. And I'm going to actually, I need it to be below 30 in order for this to work out, because I'm going to buy the 30 strike. Let's close this down. Let's buy the 30. And then we're going to sell the 35. And I wanted that to be around 250. I wanted to do 250 to make 250. But the volatility skew is not allowing it. It's not happy. You're paying a lot more for this option as far as juice is concerned than you're receiving on this option contract. And you can see, even though the numbers aren't really right, you can just kind of see that in the volatility. But usually VIX chains aren't right because they don't use the futures contract to determine those numbers. Yeah, that's not a ton. I think we do the short call spread for $1, and I'll do it a few more times. Either you buy an option contract outright and you plan on getting out halfway through, right? 44, you don't go beyond 23 days to expiration. You give it 20 days for it to play out because you're paying so much in juice. But if in that instance, that would be either buy it outright or let's sell the call spread. And I think that's going to be my official paper trade. We're going to sell the call spread. The market at 2750. We're going to sell the 30s. Our recent one, we're going to need it to be below 31. We're going to go out and double down on our position. We're going to sell the 30s, buy the 35s. That's the wrong one. Let's make this a buy. And I like the dollar once again. That's it. 45 days. And the VVIX, you're selling so much premium that if the VVIX comes in, this might be profitable too. If this goes back down towards the 100 level, and this is the VIX of the VIX, and it's using 30-day options. So let's look at, I think VVIX will come up just using that symbol. Yeah. So you're seeing, here's the big spike up in volatility. Here's COVID. This is, so we're back to ranges we haven't been to in a long, long time. Going all the way back, this is 2021. The last time we were up in that level as far as the VVIX is concerned. So you're selling a lot of juice here. Yeah, I like this trade. I like this one better. This is going to be the official paper trade. We're going to try to get it done. We'll get it done for 105. Like I said, I got the trade filled in my own account on the 14-day option. Well, I guess it's 9 days now, right? On the 9-day April 16th option contract for 105. I'm going to try to do this one for 105 too. We need the market to come down below 30. It's going to be down a little bit on that instance. And we need the market and to do it over the next 44 days. So we got a lot of time to work this one out. And that's where we're at. The market right now is at 2750. The market on the April 16th contract is right around, 30, 31. We'll call it 30 and a half. And that's where those two trades are at. And I do got a comment. Wow, Wayne, I haven't seen you in here in a while, Wayne. Hope you are well. I've got put Nike. Yeah. I've been selling calls against us, but the lower delta calls are not collecting much premium. Yeah, Nike's a concern right now, Wayne. If I would do anything in Nike besides sell, I would look at trying to collar the position. And the collar means, Wayne, what do you think of this strategy? Closing the long shares and then selling at the money puts to collect max premium. I think I would collar it. I don't know where. Let's look at Nike. I don't know where Nike's out is at. It's just that's a nice. That would be make a nice ski hill if you were riding it. But at 65 here, and then we'd bump down to 55. I think I'd buy some protection and I'd get out if it. I see. Here's the thing about doing the collar is if we get to bounce back, you just don't want to get pegged on it. So if we go at 25 days and you own 100 shares of stock, and this would apply to NVIDIA, you can do this on any of the stocks that you would like. This isn't a bad way to go about it. Premium is extremely high, except, man, and just even from the news headline that we saw today about the fake news, I mean, the markets were down, and instantly became profitable. So if there's news headlines and policies get changed quickly, the market's reacting extremely fast. So that scares you a little bit. Wow, look at this. 6,000 puts are sitting over here in open interest on this 46 strike. Somebody's long a lot of puts or a lot of calls here in Nike at the 46 strike at that lot. Okay, so here I digress. Wayne, here's what I would do. I would look at a collar. You own 100 shares of stock, right? You're going to go at 25 days. Yeah, give it 18 days. Give it 18 days. I don't want to go too much because I don't want to get pegged. I want my call option to expire worthless. But over the next week, there's, Nike in particular, I don't think they want to bring shoe manufacturing back to the U.S. It's a dirty business. So I don't know where they go. They're going to have to go somewhere. Stocks at 54. Maybe buy the 52s and see what we can sell on the other side. Implied volatility is 77, 290. And then, man, that's expensive. You got to sell the 57s to come close. Wow, that's even hard to do the collar here. Yep. So if you hit this, I'm just going to put it in there to show it. 2 points below and 2 points above over the next 18 days, and you get it done for a net debit of a dime. You can't even get it for even. Man, the skew is bad. What's the vol on this one? The vol is 75, and over here the vol is 84. So you're paying 84 vol points to buy that 52 strike put, and you're selling 75 vol points to get the 76. A lot of times, if you do a collar like this, you go further out in time, it's a little bit more advantageous. But you can usually do this and get a couple more points. You buy that put and you sell the 59 strike, and you can come close to paying for it. It's a tough market. It's a tough market. The only other trade that's out there is a back ratio where you're actually, we call it a pay later put. Trying to get it done for a net credit, but man, I don't think that's even feasible. So you buy this one and you sell two of these. You sell this one, you buy two of these. Yeah, $2.50, $3. No, I don't like any of it. I don't like any of it, Wayne. What do you think of this strategy? Closing the long shares and then selling at the money puts to collect premium. Maybe, but you're going to create if you get put the stock, I would rather just protect the stock. The collar doesn't really look good in the short term. Maybe go a little bit further out. I digress a little bit, but man, that's a real tough situation. Just this underlying, there's so many questions as far as manufacturing is concerned when it comes to the shoe markets. I kind of feel bad for Nike, to be blunt, to have to try to make these decisions on where they're going to go to next. Okay, so I digress. Let's go back to Disney. I wanted to highlight that Disney right now is trading at a real interesting area on the chart. And we got a little bit of a pop-up today, but if you look at this is COVID, so we're below the COVID levels. This is the bottoming out in Disney, and we're right there. So if I'm trying to look for a dead cat bounce, I think I'm going to do a shorter term trade. We got a little bit of positiveness in the underlying stock right now. Let's highlight where we're at. Now it was up for a minute, as you see the white candle that's here. It was up for a second, but we came right to this level And I do think we can get a little bounce. So I want to trade some of this volatility. And Disney is going to be the underlying that I'm going to pick. I'm going to look at a short-term, short-term spread. I don't know if we can be buying any options outright. And hopefully we get a little dead cat balance in Disney here. We're at 82.56. And we're going to straddle the market. So we're going to buy the first of all, we're going to go 4 days. We're going to buy the 80 here, 4 days out. And we're going to sell, we're at 82.20, the 84s. So that's 227. So we're going to go 4 points. We got a 4-point wide spread, and we're going to pay $2.34 for that spread for the next 4 days. So our profit and loss, if we send this to the what if calculator, maybe we sell the 165. Maybe we get a little bit more upside. If we look at, we're basically close to break even, right? Well, I'd like to pay $2 to get $2. But if we look here, we're buying the 80 at this level. Our downside would be 236, and you're seeing that all the way over here. And our upside would be 164. So not quite 50-50. I would like to get this to be 50-50. Maybe I would adjust it a little bit to do that trade. But this is just looking for a short-term bump off of a very strong support area in general, just from looking at the chart. Considering that, I mean, we're talking about being below where Disney plummeted to after COVID, at the very lows of the market in Disney, and we're all the way back to those levels, and we're just touching it for the first time. Now, this is trying to catch a falling knife, and I'll highlight right here where we came down and just touched. So it's a very short-term trade looking for a short-term bounce. Now, the other way that we could go about this is we can sell the short put spread to get bullish. Let's look at that one. Let's flip it to the other side. I just don't like that we're right there. I want it to be more 50-50. So let's close this. Let's sell a put spread. I think I'm going to make this one the official paper tech trade. 82. Yeah, let's sell this. So we're going to sell that, and we're going to buy this. Come on. 125 net credit to the account. We are 5 points wide. Yeah, that's going to be the paper trade. I'm not going to do the 50-50 bet. We're going to sell the 81 strike put and buy the 76 strike put. We're going to receive a net credit of $1.25 to the account, and that will be our paper trade for this week. Selling a short put in Disney, hoping that we do get some holding of the support. Disney's at lows, not necessarily the company is trying. It's coming back. There's a lot of people that have thought that Disney was a buy down at these levels before the markets all started to tank right around here. And now we're all the way back to the most recent lows, going all the way back to 2021. So yeah, that's going to be our trade in Disney for this week. Any other questions on that? We are there. We are at time. All right. Thanks for tuning in. Gave you 2 trades today. So let's summarize. We're going to look at a May expiration in the VIX. The May futures contract is at 27.5. Hoping that the market in the VIX can come back down below that level. Like I said, if it was 25, I'd be iffy, but I like it at 27.5. Selling a short call spread, trying to collect some premium there. And then we're going to look for a dead cat bounce in Disney, trying to catch a falling knife, looking for a very short-term recovery. Mondays are usually some of the worst days in the marketplace, especially when headlines are driving where the market is at. And that's going to be our short-term trade. And we'll come back on Wednesday, 11 a.m. for the next edition of Options Guide TV. See you there, and we'll see where the trades are at. And, I have to say this, but be safe out there.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.